All right, let's jump right into this explainer. We're going to take what usually looks like a confusing, chaotic wall of accounting numbers and transform it into a clear, intuitive story about a business's health. Now, if looking at spreadsheets makes you want to slowly back out of the room and gently close the door behind you, well, you are absolutely in the right place. Today, we're taking those raw ledger balances and decoding them into the two most critical reports any business owner, manager, or investor really needs to understand: the Statement of Comprehensive Income and the Statement of Financial Position.
So a lot of people see a bunch of cash sitting in their bank account and they just naturally assume, hey, we're highly profitable. But as we'll see today, that's a really dangerous assumption to make without looking at the full picture. Imagine a business that just banked $100,000 from a massive sale. They're feeling on top of the world, right? Completely cash rich today. But what if they owe a supplier $150,000 next Tuesday? Sure, they have cash right now, but structurally, they're facing a severe crisis. You literally cannot judge a business using only one isolated figure. You need the complete story to know if you're actually building wealth or just floating on borrowed time.
To get that complete story without the overwhelming cognitive load, we've built a roadmap. We're going to hit 4 stops. First, decoding business numbers. Second, measuring profit and loss. Third, taking a snapshot of financial health. And finally, connecting the two statements. Section 1. Decoding business numbers, the video versus the photograph. Right, so before we even touch the actual statements, we've got to deal with the raw data. Accountants call this the trial balance. It's basically just a massive, unorganized list of everything the business has done. To actually make sense of it, we have to process that raw data through 2 totally distinct lenses. And the core metaphor we use here is a really fun one. It's the difference between a moving video and a frozen photograph. The Statement of Comprehensive Income, that's your moving video. It captures your dynamic performance, all your sales coming in, your expenses flowing out, over a defined period of time, like an entire 12-month year. On the flip side, the Statement of Financial Position is your frozen photograph. It captures exactly what you own and exactly what you owe at one specific frozen date, like the stroke of midnight on December 31st. You absolutely need both, the moving context of the video and the grounded reality of the photo, to truly understand what's going on in your business.
Section 2. Measuring profit and loss, pressing play on the video. So as we hit play on our financial video, we can watch the dynamic energy of sales coming in and costs going out over the entire accounting period. This statement really just answers one simple, burning question. Did the business actually make a profit, or did it suffer a loss? Let's walk down the ladder step by step to find out. We start up at step 1 with net sales. This is your raw, top-line revenue, but, minus any goods your customers returned or discounts you gave them. But you don't get to keep all that revenue, obviously. Step 2 requires subtracting the cost of goods sold. This is the direct raw cost you actually paid for the physical inventory you just sold. The result? Your gross profit. This tells you if your fundamental business model even works, meaning you're selling things for more than they cost to acquire. Finally, in step 3, we subtract all your everyday operating expenses, stuff like monthly rent, employee wages, marketing, to arrive at the ultimate bottom line, net profit.
Let's ground this with a concrete example from our source material, Borneo Trading. The math here is pretty undeniable. Over the year, they generated $54,000 in net sales. From that, we deduct the $31,000 it directly cost them to buy those goods, leaving a seemingly healthy gross profit of $23,000. But a high gross profit absolutely doesn't guarantee safety if your operating expenses are out of control. You still got to keep the lights on, run the administrative office, and pay the staff, which for them adds up to $16,700 in total expenses. When the dust finally settles, Borneo Trading is left with a neat net profit of $6,300. The video has stopped playing for the year, and this is our final score for their annual performance.
Section 3. Snapshot of financial health, freezing the frame. Now that the year is officially over, we're going to slow the pacing way down and just freeze time on the exact last day of the year to evaluate the business's structural stability. The very first piece of our frozen photograph is the assets. By definition, these are resources controlled by the business that are expected to provide future economic benefits. Simply put, it's what you own. To understand your liquidity, accountants usually break this down. You have non-current assets, like heavy manufacturing equipment or delivery vehicles you'll use for years to come, and then you have current assets. These are highly liquid things like cash sitting in the bank today, unsold inventory on your shelves, and money your customers currently owe you that you expect to collect real soon.
But look, as we all know, you rarely own everything free and clear. And that brings us to the second part of the photograph, liabilities.
These are the obligations owed by the business to external parties. In plain English, this is what you owe to the rest of the world. Just like your assets, these obligations are categorized by time. You've got long-term liabilities, like a massive 10-year commercial mortgage on your warehouse. You don't need to pay that off tomorrow. But you also have short-term, current liabilities that are super pressing right now. We're talking unpaid supplier invoices for goods you already got, or accrued wages, which means paying your employees for that final week of December that just hasn't cleared payroll yet.
So here is the absolutely crucial point. Once you take everything of value that your business controls, your total assets, and subtract every single obligation you owe to outsiders, your total liabilities, what remains? The answer is owner's equity. This represents the owner's true claim in the business. It's the absolute core of the entire accounting equation. It is the exact measure of what is truly yours at the end of the day, completely free and clear from any creditors or banks.
Think about how every single asset is actually funded. Every piece of equipment on the factory floor, every bit of inventory in the back room, every dollar in the checking account, it's all funded by a mixture of two distinct sources. One part is the money you owe to others to finance those assets, say about 33%, and the rest, the other 67%, is the retained value that belongs entirely to you, the owner. Understanding this specific ratio is an absolute game changer for understanding your financial stability. If that borrowed slice gets too large, literally one single bad month could wipe out your equity entirely.
Section 4. Connecting the two statements. The aha moment.
Okay, this brings us to the climax of our explainer. This is where the moving video of your annual performance crashes directly into the frozen photograph of your financial position. It's that beautiful moment where accounting finally makes perfect logical sense. Let's spotlight that exact net profit figure we calculated for Borneo Trading earlier, RM 6,300. This specific number doesn't just sit on the income statement as a vanity metric and then vanish into thin air at the end of the year. No way. It has a destination. It has a vital job to do for your future wealth. That RM 6,300 migrates directly down into the owner's equity formula on the statement of financial position. Let's walk through exactly how this works because it's super cool. We start with the opening capital. That's the amount of value the owners started the year with. Then we actively add the net profit of RM 6,300 that the business generated. After that, we just have to subtract any drawings. Drawings are simply the cash or inventory the owner took out of the business for personal use during the year. We have to subtract them because, well, taking assets out means they can no longer be used to generate future wealth. After doing that math, the result is your closing capital. This proves a vital business reality. The operational profit you earn over the year actively and permanently increases your overall wealth and structural claim in the business. Because of that direct transfer of profit into equity, the entire equation perfectly balances. For Borneo Trading, if you add up the value of everything they own, their total assets are RM $57,600. And if you add up their total equity plus liabilities, it equals exactly RM $57,600. This satisfies the fundamental unbreakable rule of accounting. The two sides of the ledger absolutely must mirror each other. If these numbers don't equal each other perfectly at the end of the year, it means something was misclassified, omitted, or just flat out calculated incorrectly during the translation from the raw data. Now, to get those numbers to balance so perfectly, an accountant first has to make some crucial end-of-year adjustments. Relying purely on the raw, unadjusted data just isn't enough to tell the true story. For instance, you gotta account for closing inventory. Those unsold goods actually uniquely impact both statements. They lower your cost of goods sold on the video while appearing as a tangible asset in the photograph. You also have to adjust for accrued expenses you legally owe but haven't paid yet, and prepaid expenses you've already paid for but haven't actually used. And critically, you must factor in depreciation. Actually, think about it. Without depreciation, you look at your books and think your 10-year-old delivery truck is still worth what you paid for it on day one. That completely warps reality. These adjustments are what ensure the financial story reflects real-world conditions. And ensuring the story reflects reality brings us to a really powerful foundational principle highlighted in our sources. Good accounting is not only about balancing numbers, it is also about reporting truthfully. A perfectly balanced spreadsheet means absolutely nothing if it's built on omitting massive upcoming expenses, hiding dangerous short-term liabilities, or vastly overvaluing aging assets. Accurate representation is the essential foundation of all useful business data. If you manipulate or ignore those adjustments just to make the profit number look good today, you're really only blinding yourself and any potential partners or investors to the actual structural reality of your business. So, I'll leave you with this provocative thought.
Now that you have the decoder ring to translate a chaotic list of transactions into a clear, connected narrative, what are your own financial statements actually saying about your future? Are you merely cash rich for the moment, or are you methodically building sustainable equity for tomorrow? Take these concepts, apply them to your own ledgers, and please stop just looking at your bank balance. It's time to start reading the true language of your business.